European equities enjoyed a strong rally in 2025 as easing inflation and the prospect of lower interest rates revived investor confidence. Outperformance, however, was highly concentrated in value-orientated and cyclical areas of the market. Banks, utilities, and defence companies were the standout performers. Banks in particular have done remarkably well and are one of the main reasons why value has outperformed growth in Europe over the past 5 years. If you had exposure to these areas, life has been pretty good. If you didn't, it's been much harder. We do own a profitable private defence company called Techiver that manufactures drones. However, we don't own any banks or utilities. Instead, we try to own quality businesses run by people we trust, exposed to structural growth, not just short-term macro tailwinds. Times like these are difficult. They test your patience. However, historically, our strongest long-term outcomes have often followed periods when we were most out of favour with prevailing fashions. Over the financial year to the end of September 2025, we delivered a share price return of around 14.5%, roughly 1% behind the index. Much of that return, however, came from the narrowing of the discount to NAV or net asset value and an exceptional contribution from one of our private holdings, Bending Spoons. This is now by far our largest holding, which continues to beat expectations. This is an Italian software company that acquires digital consumer apps such as Evernote, Vimeo, and AOL at very attractive prices. Then it uses its internal technology stack and AI tools to materially improve monetization and efficiency. Its founder, Luca Ferrari, has also built one of the most impressive corporate cultures we have ever come across. Now, there's always a risk of highlighting your biggest and best performing holding, but whether Bending Spoons remains private or eventually lists, we believe its long-term prospects remain very attractive. We also saw strong contributions from public holdings. Spotify is a good example of patient growth investing paying off. After years of heavy investment, it is now monetizing its scale and innovation with higher prices and improving margins. Ryanair was another highlight. European travel held up better than expected, and Ryanair's cost advantage was clear. Fares rose, costs barely moved, and profits reached record levels. This is not the most glamorous business, but it is extremely well run. Some companies had a tougher year. Digital mortgage platform Hyperport was hit by a weak German housing market, while chemicals distributor IMCD faced headwinds from excess inventories and lower volumes after several strong years. These are not broken businesses, but areas where demand has temporarily cooled. Soitec, a semiconductor wafer manufacturer, faced similar cyclical pressures. In that case, however, we lost confidence in the management team and decided to sell the position. Over the second half of the financial year, we initiated new positions in 5 companies: Grupa Kente, Amplifon, Roche, Sandoz, and Techiver, spanning industrials, healthcare, and defence technology. Each shares the defining characteristics we look for: underappreciated structural growth, strong and improving competitive advantages, disciplined management, and the potential to double in value over a 5-year period. To fund these new investments, we sold 3 holdings: VNV Global, Genmab, and BioRef. You can read more about these and Bending Spoons in our annual report, but another observation I have is that it has been a very long time since we've been able to buy companies like these at such low valuations, and that gives us a lot of confidence about future returns. Looking ahead, our approach remains firmly long-term. We do not attempt to forecast short-term macroeconomic or political outcomes. Instead, we focus on what we can control: the quality of the businesses that we own and the prices we pay for them. From that perspective, We believe the portfolio is well positioned. We see increasing evidence of operational progress, including rising margins, resilient cash generation, and strengthening competitive positions. We are encouraged by the improving outlook for Europe and by the strength and quality of the companies we own, which in aggregate grow faster, are more profitable, and carry less debt than the average European business. With patience and discipline, we believe this combination should translate into attractive long-term returns for shareholders. We thank you for your continued support.